Why could the 20-year Treasury bond be gone again soon? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So let's talk about what happened in the universe of bonds last week as the bond market roller coaster continues. Here are the 3 topics that we'll be covering in this week's update video. 1. Will the Treasury get rid of the 20-year Treasury bond soon? And what happens to TLT in that instance? A very timely question, given that the Treasury will be auctioning off $16 billion of 20-year T-bonds this coming week. Could this be one of the last chances to get some if you're interested? And for those of you who don't know TLT, TLT is BlackRock's iShares 20-plus year Treasury Bond ETF. 2. Where did Treasuries end last week? And 3. What's on the upcoming Treasury auction schedule? And what are the highest yielding new issue agencies, corporates, and brokered CDs currently? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Our Diamond NestEgg regulars have heard me say this before. If you're looking at longer dated treasuries and plan on holding to maturity, the 20-year Treasury bond is often worth considering as it generally yields a bit more than the 30-year Treasury bond. And as you can see here in these examples, the yield on the 20-year T-bond has actually been consistently higher than the 30-year T-bond recently. And no, this has not been caused by our overall inverted yield curve, because at the longer end, for everything above 5 years, the yield curve is currently sloped correctly. Meaning that if we start from the 5-year Treasury, the 7-year, the 10-year, and the 30-year all earn progressively a little bit more the longer their maturity. The odd exception is the 20-year here, which earns more than the 30-year, and that should normally not be the case. Because remember, the longer the term of a bond is, the higher the return a bond investor will usually demand, because the longer he or she is exposed to these 7 key risks of bond investing. Bond beginners, folks, please refer back to Module 2 if you need a refresher on any of these risks or points here. So, the 20-year Treasury bond seems to be a special case, and it has seen its starts and stops in the past. The Treasury actually stopped issuing the 20-year T-bond in 1986, but then, after nearly 3.5 decades, in May 2020, the 20-year bond was reintroduced during the pandemic as the government needed to urgently finance the stimulus packages that they were rolling out one after another. But it seems that the Treasury may have overestimated the appeal of its new offering. The Treasury has increased auction sizes of the 20-year T-bond multiple times since its reintroduction, hoping perhaps that higher liquidity would help with acceptance by traders and investors. But the 20-year still commands a higher yield than the longer-dated 30-year, as we mentioned earlier, as well as a higher yield than the 10-year. The lack of enthusiastic buyers, and as a result, the lower liquidity for the 20-year versus the 10-year and the 30-year Treasuries just seems to be deeply rooted in the market for whatever reason. And it's costing the federal government and us American taxpayers a lot of money. According to Bloomberg, since the Treasury reintroduced the 20-year bond in monthly auctions 4 years ago, their sale has tacked on roughly $2 billion a year in interest expenses on top of what the government would have otherwise paid. That's some $40 billion over the life of the bonds. No wonder then that Steven Mnuchin says that it's time to kill the 20-year Treasury bond that he initially created. That's right. Steven Mnuchin, the former United States Secretary of Treasury, who called for the reintroduction of the 20-year T-bond in 2020, is now saying we should get rid of it just 4 years later because it's just costly to the taxpayer. And it's not just for Treasuries that the 20-year maturity does not seem to interest many potential buyers. The corporate bond market also does not see many issuances with a 20-year maturity relative to the 10-year and 30-year maturities. In fact, the Treasury itself replaced the 20-year TIPS with the 30-year TIPS in 2009. So what do you think? Given that the 20-year maturity looks like the unloved child of the bond market, should the Treasury stop issuing 20-year T-bonds that cost us taxpayers roughly an additional $2 billion in interest annually? Or are you one of the members, super savers, or bond courts folks in our community who like picking up the 20-year at auction to get a bit of a higher yield? Drop a comment below and let the community know. Now, some of you have also asked what the potential demise, again, of the 20-year Treasury bond might mean for ETFs that try to mimic exposure to long-term Treasuries, such as iShares TLT, Vanguard's VGLT, and State Street's SPTL. All of these ETFs that I just mentioned currently have effective maturities of 22 to 25 years across their portfolios, so are close to the 20-year. That said, in my mind, I don't think the potential discontinuation of the 20-year T-bond will necessarily threaten these ETFs in their existence. They're all trying to replicate exposure to long-term Treasuries, and they will be able to do that with a 30-year Treasury bond. And the secondary market will, of course, still offer the possibility to buy 30-year bonds with a remaining maturity of 20 years, or any other remaining maturity for that matter. So there is no fundamental reason why these funds couldn't maintain their current profile. But every investment product needs willing buyers. And that leads me to an important point here. Tradable ETFs, TLT, VGLT, and SPTL are typically more popular products for professional traders and more adventurous private investors who want to bet on interest rate changes and their effect on long-term bond prices. But these are not necessarily products we would recommend to most long-term buy and hold investors. So we will need to see how the prime target group of trading-minded buyers for these ETFs will react if the 20-year Treasury were to actually go away, and whether the loss of a potential arbitrage opportunity will impact their investment behavior. But that could be the topic for an entire video of its own on how best to invest in long-term Treasuries, depending on whether you're a long-term buy and hold investor or more trading-minded. Drop a comment below and let us know. What are you, a long-term buy and hold investor or more trading-minded? As for us here at Diamond Nest Egg, we'll keep following the developments on the 20-year T-bond and let you know what happens next. Because as of right now, the 20-year T-bond is still on the auction schedule until at least the end of the year. So, with that in mind, let's move on to the next section of today's video. As we so often do at the end of a week, let's see where we stand and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Results for the week were pretty uneventful at the shorter end of the yield curve. The 2-month, 3-month, and 6-month T-bills were literally unchanged. The 2-year and 3-year were slightly up by 1 tiny basis point, but all the other maturities were down for the week, and in particular on the longer end. Due to a combination of cooling inflation, better than expected retail sales, and signs that the labor market may not be weakening as fast as previously expected. Basically, in the first half of August alone, the market has swung from one end of the pendulum to the other and then back again, from a possible soft landing and likely 25 basis point September rate cut to a possible recession and significant rate cuts at consecutive Fed meetings, and then back again in the other direction. Let's see which direction the pendulum will swing this coming week, after Fed Governor Powell speaks at their annual Jackson Hole Economic Policy Symposium. But it seems the markets are expecting Powell to prepare the stage to finally, actually, definitely start cutting rates in September, as you can see here. Only time will tell, I guess, and we'll be watching this carefully here at Diamond Nest Egg for all of you who's as interested as we are. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. The 20-year and 30-year T-bonds are now back up very slightly from where they started on January 2nd, but yields across all these other maturities are still lower than where they were at the start of the year, with the biggest differences still seen in the 1-year and the 2-year Treasuries. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see that the 20-year T-bond that we mentioned before, as well as the 29-year 6-month TIPS, will be auctioned off as well this upcoming week. The 20-year T-bond is not a reopening auction, so the coupon is still to be determined. The 29-year 6-month TIPS is a reopening auction of the previous 30-year TIPS, so we already know what the coupon will be on this one. At the time of this taping, here's what the coupon and the expected yield are for the 20-year T-bond. And here's what the coupon and the expected yield are for the 29-year 6-month TIPS on Fidelity's platform. Do keep in mind that these numbers here can and usually do change all the way up to the time of the auction. For those of you interested in agency and corporate bonds for a bit of a higher yield, here's where the highest yielding new issue agency bonds stand at the time of this taping. For corporate bonds, here's where the highest yielding new issues stand at the moment. And for brokered CDs, here's where the highest yielding new issues are currently. Remember that regardless of whether we're talking about agency bonds, corporate bonds, or brokered CDs, at the moment, the higher yielding ones that are a bit further out in terms of maturity are generally callable. So keep an eye out on when the first call date might be on those. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to learn about the safest, easiest, and fastest ways to get started with bond investing and building out your bond portfolio, especially in times that may see continuing market turmoil, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on August 21st at 6 p.m. Eastern Time, 3 p.m. Pacific Time to continue the discussions further on all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and CDs this week, and see you again very soon with more brand new wealth building content for your financial journey.